close to our 3% objective. It was a bit higher towards the end of the year, mainly because of temporary factors. The December print came in at 3.6%. However, we expect this was the peak and that inflation will slow from here. Indeed, over near-term inflation forecast has fallen, with the rand stronger and a lower oil price assumption. We are, however, keeping an eye on food inflation, especially meat prices, which are being affected by a serious outbreak of foot and mouth disease. We are also concerned about electricity prices, given that NERSA's price correction may rise from 54 billion rands to 76 billion rands. More positively, inflation expectations have fallen, with the latest survey showing longer-term expectations at record lows. We look forward to expectations declining further as South Africans experience ongoing lower inflation and learn more about the new target. In turn, lower inflation expectations will be important for getting inflation to settle at 3%. Currently, we are benefiting from low goods price inflation supported by factors like the stronger rand. Goods inflation is at 3% and core goods is at 1.2%. By contrast, services inflation is still over 4%. It is desirable to have services inflation moving closer to 3% as low inflation becomes the new normal for South Africa. We assess the risks to the inflation outlook as balanced. Against this backdrop, the MPC decided to keep the policy rate unchanged at 6.75%. Two members favored a cut of 25 basis points, while 4 preferred a hold. The quarterly projection model continues to forecast gradual rate cuts as inflation subsides. The model interprets the policy stance as moderately restrictive currently, with rates reaching neutral levels during 2027. As before, this rate path remains a broad policy guide. Our decisions will continue to be taken on a meeting-by-meeting basis, with careful attention to the outlook, data outcomes, and the balance of risks to the forecast. Moving to our scenarios. Over the past year, there have been large changes in both the exchange rate and oil prices. Our baseline forecast assumes these prices will stay roughly where they ended in 2025, but the outlook is uncertain. We considered a pair of scenarios: a favorable one where the rand is stronger and oil keeps falling, and a more challenging one where the rand weakens and oil goes up again. In the adverse scenario, inflation peaks at 4%, and the convergence to the 3% target is lower. Interest rates are largely unchanged in the near term, with the shift down to neutral delayed by about a year. In the positive scenario, inflation gets as low as 2.3% temporarily. In this context, expectations ease faster and inflation ultimately settles near 3% more quickly. This allows front-loading of interest rate cuts, with neutral reached during the current year. These scenarios show that even quite large shocks like those modeled would not push inflation outside our tolerance range of 3% plus or -1. They also demonstrate how supply shocks interact with inflation expectations. This affects how fast we deliver on the 3% target. We are trying to anchor expectations at 3%. Positive shocks get us there sooner, while negative shocks delay the process, but don't block it. Overall, monetary policy appears well positioned to manage the range of shocks that might come our way. To conclude, 2025 was a watershed year for the South African economy. Despite a volatile global backdrop, there was significant progress on domestic reforms, including a new inflation target. These efforts have been rewarded with lower borrowing costs, a rapid decline in inflation expectations, and steadier growth. It is crucial to sustain this progress. For monetary policy, our main contribution is to deliver on the new target, which means stabilizing inflation at 3% over the next few years. Further gains in economic performance would come from reaching a prudent public debt level, lowering administered price inflation, and continuing structural reforms that raise potential growth. That concludes our statement. And at this stage, I would like to invite you to pose any questions that you might have. And we would then ask members of the committee to deal with your questions. And as usual, your name and the media house you represent.
Thank you very much. Good afternoon, Governor and the rest of the panel. My name is Ntando Tsukwana from Bloomberg News. Governor, we're seeing that you've decided to hold rates and you're describing your policy stance as moderately restrictive, yet we are seeing a slight improvement in your inflation forecasts. And I'm just wondering, on the balance of risks, is it a fair assessment to say that global factors were a bigger consideration in making this decision? Yeah, thanks very much. And maybe if you could spell out more in specific detail what those global risks that you're seeing are. Thanks very much.
Afternoon, Kopano Kumbi from Reuters.
Yes, Kopano.
Similar, my first question is quite similar to what Ntando was saying. You know, the statement reads almost as if you think conditions are too good to be true and you're waiting for this other shoe to drop, and that's why you've chosen to hold. And so I'm wondering if you think the risk of inflation running too hot because you're on or ahead of the curve is really that high, or otherwise why hold now? Or are you waiting for expectations, inflation expectations, to fall further before you consider cutting again? And then it's the new year, so I have a few questions. Is the rand strength a surprise to you at all? It's fallen lower than you had guided for even last year, so just wondering if that means anything to you, the rand strength. And in your view, in light of that, in your view, is rand strength purely based on dollar weakness, or is there some other element or even lower country risk premium that's at play that's driving the rand lower? And then lastly, in the statement, you say global trends are not sustainable. So, you know, China one side, the US other side, etc. So do you see a risk of a recession? Thank you.
Last one. There isn't.
Good afternoon, governors. Naledi Ngobo from the SABC. So my question is with regards to the different stances among the members. You did say that 2 members preferred a cut. Can you maybe give us the reasons why they were hoping to see a cut, or why they favored a cut? And also in terms of the growth that you're seeing, you're forecasting a growth of 2% in the medium term. Should you see growth maybe rising a little bit faster at a more rapid pace? Do you foresee inflation, also going up, or do you think inflation will remain low despite rapid growth on the back of maybe household spending as well as maybe greater investment?
Thank you very much. Let's start with Ntando. The balance of risk, we see them as global. The risks are risks. Let's start with the global risks. We had highlighted the issue of heightened geopolitical tensions, and all indicators of geopolitical uncertainty shows that it is on the rise. Secondly, we have trade uncertainty, trade policy uncertainty. And this, again, if you look at measures of trade uncertainty, they had been on the rise. And it becomes particularly challenging given that most now of the trade agreements are taking place outside of the multilateral system, which is the World Trade Organizations. And so you will end up with this spaghetti bowl because everyone is trying to reach a deal for themselves with somebody else. And lastly, there had been the issue of economic policy uncertainty. And here we had highlighted the rising or elevated debt levels globally, mainly in the public sector. The OECD had raised this repeatedly, and the Financial Stability Board had highlighted this as potentially a financial stability risk. Now you have got all of these uncertainties, and you have got the risks that we see that are emerging. The question is, how do they translate into the South African economy, and what are the channels? And we know that with the trade tensions create the uncertainty. We have had a 30% tariff slapped on South African exports to the US. We had seen the impact that this would have on the auto industry and initially on the agricultural industry, although I'd seen now there had been exemptions of some of the agricultural products. So the risks are on the global that are flowing domestically. But there are also our own risks. On the inflation front, electricity prices remain a risk for us. We have highlighted this, and Eskom and NERSA had reached an out-of-court settlement, but there are now other interventions through the courts. That is an area of uncertainty and potentially a risk. When we looked at all of these risks and we assessed the risks to the inflation outlook, we saw them as balanced. What are the balancing ones in terms of inflation? Firstly, you have got a strong rand. You have had contained or stable oil prices, and that is positive for the inflation front. But I have also highlighted all of those uncertainties globally that could actually manifest themselves in. Which sort of then takes me to the question that Kopano had raised. She seemed to say that she is raising the same as you, but they look very different. But hers is also related to what Naledi had raised with respect to growth rising and whether that would lead to a rise in inflation. Now, inflation is not running away from us. It is not. Our baseline is that inflation will converge to target by 2028. It will be bang on target, 3% in 2028. But the trend, last year we came out with an average of 3.2. At the November meeting, we expected growth this year to average 3.5. We have revised that a bit. We think that it will average 3.3. And in 2027, we expect that it will go to 3.2, 3.1. And then in 2028, we will then be bang on target. Now, the reason why we presented scenarios was to stress test the path towards the target. And we presented a positive scenario that says that the rand strength continues and the oil price declines, and what that would actually mean. And we also ran another scenario that says, what if the rand weakens and the oil price goes up? What would it show? In both scenarios, we will still be able to achieve our target. But the point that you were then raising about the running away, which links up to Naledi's question about growth rising and whether it would lead to inflation. Growth rising can only lead to inflation if growth rises faster than the potential growth and thus close the output gap or make the output gap turn positive. We had presented for you in a sheet what we think the evolution of potential growth is, of growth, and of the output gap over the next 3 years. For all intents and purposes, the output gap is closing. It is negative 0.3 this year, and then it declines next year, and by 2028 it will be 0. If you use that as a pure measure of slack in the economy, you would then say, actually, monetary policy should be tightening. But you decided that, no, we will keep this the same, because slack is just but one measure. We have got to look at what else is going on in the economy. And thus, we highlighted what has been happening with food prices and what has been happening with the fuel price, which has registered negative inflation, and we expect it to be registering negative inflation again this year. That is where we are actually looking at. So the measure of slack here says that, yes, the growth is rising, the output gap might close by 2028, but just bear in mind, this is not quite an observable variable. And so the potential growth rate might change over the next 3 years as well. So don't take it as fixed and therefore the output gap has closed and therefore we are having inflation running away from us. It is not. You raised the issue of rand strength or whether we were surprised. There are lots of things that central bankers do not control, and the exchange rate is one of them. And we take it for what it is. There are both push and pull factors that had contributed to rand strength. And the first one you had identified, which was, is it dollar weakness? And of course, with the dollar weakness, we saw that the dollar had weakened against major currencies. But the rand didn't just strengthen against the dollar. It strengthened against many other currencies too, and it's the second best performing currency in the emerging market universe. That then talks to what the pull factors are. Now, with people looking to diversify out of the weakening dollar, they had been buying gold. We are no longer the biggest producer of gold, but we still produce gold. And mines that might have looked unprofitable 2 years, 3 years ago have suddenly become profitable as gold has experienced safe haven flows. But gold didn't just rise on its own. It pulled other metal prices, silver, platinum, and so forth. And we do produce lots of platinum. And so you would then see that international investors would look and say that these prices are rising. Which countries are producing this? And we happen to be one such. I think that this morning there was a lead of one of the big multi-trillion dollar fund manager, which had announced that they were buying shares in South African metal producers. So you could see then there are pull factors. It's not just a question of dollar weakness. We did caution last year when, in the run-up to the adoption of the inflation target. We said that the staff of the bank had done work, and the work that they had done showed that with the adoption of a lower inflation target, expectations for inflation will decline. Expectations have declined to their lowest since the first survey of inflation expectations was done. 2, we said that the adoption of a new target will lead to a strengthening of the currency, and that strengthening of the currency will itself also be disinflationary. The target has been adopted. It has been announced. And we are actually seeing what we said would happen. We said the adoption of a new inflation target would lead to lower borrowing costs. Yes, it did, except that the borrowing costs declined faster than we actually even expected. And so there are positive things that had driven this. In the work that the staff of the bank did, said for South Africa to fully benefit from the lowering of the inflation target, fiscal policy would have to come to the party. And the Minister of Finance tabled the budget policy statement. And that budget policy statement showed that the path of fiscal consolidation is continuing. Listened to him in Davos when he said that he expects that there would be another primary surplus during the course of this fiscal year. So, yes, dollar weakness, but fundamentally, South Africa is a different place. Monetary policy reform, fiscal policy reform, and more importantly, had been that the structural reforms that we had been talking about are setting in. Structural change is slow, but it is setting in and is beginning to yield benefits, and this is being noticed. Take all of this together, and then you will see South Africa's country risk premium has also been declining. And combination of all of this do contribute to the strength of the rand. We talked about trends, that these trends cannot be sustainable. Let's be clear which ones we were talking about. We were talking about rising global debt, and we were talking about rising global imbalances. And we said that these trends are not sustainable. And if they are not sustainable, at one point or the other, there has got to be a reversal of these trends. And that reversal does not talk to a recession. Recession is not something that we had talked about at the moment. at least a global recession for that matter. If we want to, you were talking about South Africa. For South Africa, the trajectory is an upward one that we had actually seen. Yeah, I think that I have dealt with all the questions. Any other question? At the back, Alistair.
Thanks very much for taking our questions, Governor. Alistair Ball from Bloomberg. I wondered if you could talk a little bit about your scenarios, and particularly your sort of upside scenario, because it sort of like offers this tantalizing prospect of if the rand strengthens and the oil price weakens, you could get to your neutral rate this year. I think if I understood that correctly, another sort of like 3/4 point cut. So what sort of triggers would need to be, what sort of thresholds would need to be met? What rand level and oil price level did you put into your model when you ran that scenario analysis? I guess what I'm asking is, you didn't cut today, but there's a lot of good news out there, and I mean, you sound like you could have cut, and certainly some of your colleagues wanted to cut. So what would be the trigger to get you to move at the next meeting? Thank you.
Nzoguhle Sabela from Bloomberg.
Your name again?
Nzoguhle Sabela.
Nzoguhle, yeah.
How will the new 3% inflation target with a tolerance band change the way the Reserve Bank sets interest rates compared with the old 3 to 6% framework?
Last one. Any other? Okay. Chris, you talk to the scenario, and let's be clear. These are scenarios, they are not predictions. So we will say what had gone into the scenarios, and then, but you then asked what would it take for us to cut at the next meeting. All of the things we have considered is what would trigger. So it depends in which direction they move and how it changes the outlook and the balance of risks at that particular time. But you said at the next meeting. The next meeting is not the last one. There is still the May meeting. There is the July meeting. There is the September meeting and the November meeting, which is why we say our decisions will be considered on a meeting-by-meeting basis based on data and the outlook. And that is important. So while Chris is preparing to deal with the scenarios, Naledi, you had also asked a question about the reasons for those who wanted to cut. I thought, since they are only two, you would be interested in the reasons of the four who decided to hold. But I guess the point is that all the reasons as to why a hold and why a cut are all encapsulated in this statement. And that is why we talk about the risks. And we said for inflation, there are balance. There are things that could lead to inflation going up. There are things that could lead to inflation going down. And since they are balanced, it's difficult to make the call. And that is why you saw that there is a disagreement in the committee. We love unanimous decisions. But when you have a split decision, you should also celebrate, because that means that there is no groupthink in the MPC. There are people who take different views from each other. And the debates are robust, and there is serious contestations. And in the end, irrespective of what who preferred, we must still come with a statement, and we can't come here with a statement and say, well, there is a statement, but there is also another one for this two, or, oh no, here's the statement of the four, and here's the statement for the two. We now have to agree on what we actually communicate as the stance of the committee, and that is the important thing. Lowveld.
So footnote 14 in the statement provides the details of both the upside and downside scenarios. Just to recap, the upside scenario includes 3% additional appreciation in the currency, and a $10 per barrel lower oil price. So it gets you to about $51 a barrel. I'm not sure the exchange rate peak, but you end up getting a inflation trajectory that goes about 2.6 and then to 3 and then down again a little bit. And then the adverse scenario is $10 per barrel above, and then a 12% appreciation. And the difference in those two the currency movements is that since the last meeting, we had quite a lot of appreciation already coming in on the exchange rate. So we kept the exchange rate assumption for further appreciation relatively muted.
Okay.
Yes, Governor. There's a question from Artwald Lamini from Alliance News. He asks, the MPC statement talks about temporal factors that have driven inflation higher. Please elaborate on what these factors are. And secondly, what sort of risks this year and beyond may make it harder for the SARB to achieve the 3% inflation target?
Is that the only question online?
He's also asked about rand strength, but I think you've covered it.
Can you repeat temporal what?
Temporal factors.
Temporary factors
that have driven inflation higher.
That have driven inflation higher. Okay. David, you seem so enthusiastic about this question. I'm giving it to you.
That'll teach me to be enthusiastic. So the statement speaks to temporary factors that pushed inflation up towards the end of last year. You know, this 3.6% we've just seen December. We had some prints like that in the previous couple of months. We actually talked about these a lot in previous statements, so we didn't rehash all the text. But we had food prices coming up, and we had oil price deflation wearing off. So there was very, very low oil price move, so deflation in oil prices, and then that faded to about zero, and that pushed inflation up a little bit. But this is kind of a classic example of something that moves in and out of the base and doesn't have long-term effects. And that's why it makes sense that we're coming from a 3.6, but we see inflation slowing during this year that we're in now. Thanks.
Oh, I thought that was the last one. Somebody sent you a WhatsApp. Okay.
Thanks very much. Alex Winning from Reuters. One of the big themes in markets this week has been the dollar's weakness, not just the rand strength, but the dollar's weakness. To what extent is a very, very sharp move in the dollar over a course of a few days disruptive to countries like South Africa or emerging markets more broadly? So what sort of things are you monitoring in terms of the dollar's move on a daily basis? Thank you.
Thank you very much. Rashad, you watch this thing. I gave up my Reuters monitor, so.
Yeah. Yeah, look, I think that, we have, so I suppose there's the financial side. There's this question of what assets exist. You look at South Africa's net international investment position, and you ask, how much of assets do South African have abroad in dollar value? So, and to what extent does that have an impact on the dollar? So there's that particular side. What impact does it have on assets? The thing about currencies is they move. They move. If there's a sharp depreciation or appreciation of any currency, you don't know whether that is a long-term trend or whether it's kind of for a couple of days you see a depreciation and you kind of it normalizes. So I think what we have to come to terms with, whether we're talking about dollar strength, dollar weakness, rand strength, is this a new trend or is it something you look through? Whether you're a portfolio manager looking at the assets you hold or whether you're an exporter or an importer. So in that sense, I think that there's nothing special about worrying about a depreciation when you think it's sudden. I think the dollar is a special case because unlike the euro or the pound, it is numeraire currency that many people rely on, whether you have foreign reserves, it is the invoice currency. So I think for us, the bigger question is, what are the long-term implications of where the dollar goes? What does that does to the U.S. Treasury as a safe asset? But that's a more kind of longer-term question. The key thing we're going to watch now is, how will this fold out? Is it a short-term thing? Is it volatile? Or is it the beginnings of a long-term trend?
Okay. That was the thing. Enzo Kuhle, you had a question about how the new 3% target changes the way we conduct monetary policy, or the way it complicates our monetary policy. The tolerance band, how it changes. Okay. For a long time, we had stated that the inflation target for South Africa of 3 to 6% was too high and too wide. It was out of line with our peers and thus reduced South Africa's competitiveness. If you looked at the 3 to 6 target, and the Reserve Bank decided in 2017 we will aim for the middle, 4.5, you could say the target was 4.5 plus minus 1.5%. If you do that, you get 3 to 6. We did the work that showed that there would be a benefit for South Africa in having a lower and narrower inflation target. But we have also learned over the years, with a target range of 3 to 6, well, you are not supposed to miss. The target is so wide. I mean, you can hit 5.99 or you can hit 3.1. You are within the target. And the problem had been that over that period, the price setters believed that the South African Reserve Bank was actually targeting 5.99. And every time inflation dropped below 6%, there was an expectation that the Reserve Bank will cut interest rates. And the Reserve Bank obliged. And the result was that there were a number of academic articles where economists were trying to estimate exactly where in that 3 to 6 band is the Reserve Bank aiming. And they called this an implicit target of the Reserve Bank. And those varied between 5.75 and 5.99. Now, by moving to a point target, we have saved academic resources. And no one has to spend time trying to estimate what an implicit target for the bank is. It is what the bank says it is, and we had said that it was 4.5. The problem, for those who had been attending this press conference, was that every time we said, okay, our target is 4.5, and if you drop below 4.5, are you going to cut to take the thing below, back to 4.5? And then when are you going to hike now that it is above 4.5 and so forth? And it just took a lot of explanation. In the joint work with the Treasury, a decision was taken that we should aim for 3%. But since inflation is always an estimate, and these things do get revised, and since you have forecast, and forecast can be out by 0.1, 0.2, we should say our aim is for inflation to be 3%, but to give ourselves flexibility, we should allow for a tolerance where you either got the forecast wrong or you had experienced a shock and so forth. But the tolerance is narrower than in the previous one. It's 1% either way, whereas in the other one, if we were aiming for 4.5, it should have been 1.5 either way. So we have narrowed that. And that gets the price setters to be focused on that. And we are seeing it coming through the inflation expectation that it is being embedded. Put simply, it is making the job of the Reserve Bank easier to communicate because the target is 3%. we will tolerate 1% on either side, so that enables us to deal with shocks. That when there are shocks, we know the shocks will take us away from target, but we have got these tolerance bands. And that is why when we presented the scenarios, we were stress testing. If you had these shocks, what would happen to the inflation outlook? And we has established that even with those shocks, we would still be able to meet the target and be within our tolerance band. Thank you very much. That concludes the business of today. We will see you in March, in May, in July, in September, and in November.